Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie, and let's take a look at the midweek market update. Bit of a teeter-totter whipsaw waffle back and forth here on whether or not we're going to raise rates as we get a series of economic data points every day that point up, down, sideways, back, forth. We've got Fed speakers literally changing their mind a day later. So the probabilities are all over the place here lately on whether or not we'll actually raise rates. Currently, holding rates put is being favored at the next meeting in about 2 weeks. The day before the meeting, we have a CPI print, which may come down significantly from last print, which was 4.9. I think the current estimates are 4.2 or thereabouts. So that may also influence the Fed's decision. Now, we've had the Fed come out today, at least a few of the members say we should at least skip the June hike, and that has certainly been baked into those probabilities today, whereas later last week, a hike was favored. And we also have others, this is Jefferson saying we should skip the rate hike, and this is coming from Nick Timiraos, who has been the Fed whisperer, if you will, historically, as they very likely tend to feed him information that they want disseminated to the public at large. So there is an expectation here that the Fed may not raise rates again for another 25 basis points and may skip. Now, that doesn't mean they're going to hold rates at this ceiling. They may come back in July and raise rates, just as the Australian Central Bank did a month ago after pausing. And I'm sure Powell will communicate that in the meeting, that this is not a pivot. This is not a permanent pause. It is a temporary pause. That's, I guess, what they're going to come out and say. Nevertheless, DXY here on a daily basis over the past week has been extremely strong thanks to all of the Fed hawkishness. The DXY, as a reminder, is a basket of currencies relative to the dollar. If the dollar strengthens relative to those currencies, DXY should rise. So just today we saw, again, a complete about face of all of that Fed hawkishness over the past week, and down comes the DXY. From a technical perspective, TA, the DXY historically has done extremely well using TA, using probability and expectations. You know, looking at the top, there's a great case for a head and shoulders triple top situation here that broke through on trend through the cloud, and then you had your bearish trend, and now we are in the cloud once again, potentially ready for a bull trend. So even with the Fed sort of double pivoting on what they're going to do in this meeting back and forth, this still looks very strong on technicals. This is an Adam and Eve double bottom. Anything above 105, 106 is go time. And until this makes lower lows, the expectation is most certainly higher highs. Eventually, at the very worst, this may put in another U or V-shaped valley here, similar to the top, but in a much greater duration, and eventually just go for it. That's the expectation currently. Even though this is neutral, it looks very good on technicals, and that would certainly hurt anything on the opposite side of that for risk, like Bitcoin. Gold as well, you can see that things came down significantly on the Fed hawkishness and has bounced slightly. But in general, oddly, as DXY looks bullish, so does gold. So we'll see which wins out here over time, but gold still looks just as excellent to me from a bullish perspective as DXY. Triple bottom, tons of double bottom fractals there. Like I said, on the inflation estimates, I think the banking estimates are around 4.2. You know, they spit out this prediction ahead of CPI. This is Truflation. This is a real-time estimate of inflation with a different basket than CPI as far as allocation percentages are concerned, but nevertheless has led CPI extremely well, both on the top side and the bottom side, and this continues to decline. So the expectation is certainly that we're going to put in a number less than last month's CPI in 12 days here on 6/13. We also have the debt ceiling deal coming to an end here, as both the House and Senate are likely to pass some sort of deal. Even though that's being celebrated, obviously as a country, we're dealing with massive amounts of debt. On top of that, we're dealing with massive amounts of consumer debt, credit card debt, at $1 trillion, with some of the highest rates that we've seen in decades on those at 24% on average. So there's just debt as far as the eye can see, with rates higher than they've been in decades. So we'll see how this pans out. But for many, Bitcoin is that escape valve from all these nonsense, zero consequence debt raises, where eventually the chickens will have to come home to roost, and we can't just keep passing this on to the next generation. However, looking at equities, looking at the S&P, things look great. We continue to make higher highs. We continue to make higher lows. So long as we're above 4K, things look fine. Even though it's only those 7 holding up the S&P, this continues to look like a bullish reversal. At this point, you could even say ascending triangle on top of this inverted head and shoulders. There's no measure here that looks bearish to me whatsoever. If you were looking for something, you could potentially say this is a rising wedge here on this May onward period. But as maybe bearish sentiment is, on the expectation of a recession or consumer spending pulling back or inflation still roaring, none of that is really being priced in that I'm seeing on the S&P. This looks bullish. You'd have no idea. If you were on a deserted island just looking at the S&P, you'd say, wow, this looks great. This looks ready for higher highs, and this measures to 4,300 plus easy. Flipping gears to digital assets, looking at Bitcoin, looking at the proof of work aspect of Bitcoin, the hash rate, we continue to see miners all across the world. Every day it's sort of a new pocket, if it's Uruguay or if it's Tibet or Africa, South America, United States, Texas, right? Every day it's sort of a new headline of who's adding more and more hash rate to the network. And that's why we're seeing just a continued rise in hash rate. Looking at that on the weekly basis, you are seeing just continued all-time highs in hash rate. This dip here is where China banned Bitcoin mining, and all of that migrated to the United States, and that's all she wrote. Continuing to see industrial-sized miners using green energy, using renewable energy, using nuclear energy, using gas flaring all over the world. So you're seeing that in real time on the hash rate chart here. So for the network, this is excellent. Now, as an individual miner, if you are not keeping up with the Joneses, as it were, if you're not keeping up as a percentage of your hash rate of the network, let's say let's say you're not adding ASICs as an individual or entity, you're not adding hash power, you're losing profitability on a relative basis. So if hash rate is going up and you're not a part of that party, you are losing market share slowly. But this is extremely healthy for the security of the network. Another thing not a lot of people talk about is they talk about daily active addresses, which to me is kind of silly. I, as an individual, don't send Bitcoin every day. I haven't sent a Bitcoin transaction in weeks. So to look at daily active addresses for me doesn't really make sense, because I don't use it as an individual as a transaction mechanism, as a medium of exchange. I use it as a store of value. So when I'm looking at address data, I like to look at things like non-zero balances, or in this case, balances with at least 0.01 BTC. And ever since 2018, we've continued to see growth in these addresses. Now, one address could be one person, but so could 1,000 addresses. If I wanted to, I could have as many addresses as I wanted. So you can't really treat these as one-to-one, but there are 12 million addresses with at least 0.01 BTC. And even despite the massive downtrend, those addresses continue to rise, and they continue to rise in this uptrend year to date, obviously. So that to me is extremely encouraging, that we're seeing dollar cost averaging type behavior, stacking sats, as we say in the industry, regardless of what's going on with macro or with inflation. It appears as though, on balance, we're still seeing dollar cost averaging behaviors. Back to mining for just a second. I forgot to mention the mining pools have leveled out a little bit. A couple weeks back, maybe a month and a half back, we were focused on this Foundry USA pool as a slice of the network because it was extremely high. And when you reach 51%, you risk centralizing the transactions in the network, and that's not what we want here. We want, ideally, this is just a diverse number of pools where there's no single point of failure, or there's no miner that can try to cheat the system. Now, we're not anywhere close to that, but we were getting increasingly centralized a few weeks ago, and that has abated significantly, in part because Foundry added a small fee to their pool where previously it was free as a miner. So that certainly played a part, but it's good to see this pool even out a little bit. And then if we look at hash rate relative to the pool and its geographic association, we can look at the US, and you can't equate this to hash rate because you can point your hash rate anywhere to any pool. So I can be located in the United States and point my hash rate to a pool in China if I wanted to. Now the pools in the United States are, I would think, KYC AML'd in a sense in that if you're using a pool, they know who you are. That may not be the case elsewhere in other pools. These pools are associated with China, but the hash rate may be in Africa or Kazakhstan or Sweden, etc., right? It could be anywhere. There's even a smaller slice in Russia. I hadn't heard of the EMCD pool. Not really sure what's going on there, but the point is the hash rate can be anywhere in the world and point to a specific pool. So even though there aren't really that many miners in China anymore, many of the pools are still affiliated with China. But nevertheless, we're seeing massive growth of hash rate physically in the United States. Flipping gears to some technicals, if you're a long-term capital allocator, even though I talk about plus or minus 4%, 5% on a weekly basis, really looking long-term, what you want to focus on, what I think you should focus on, not financial advice, but I would be focusing on the 4-year cycles. What do those look like relative to halving, and where are we in that cycle potentially if we're expecting this cycle to act like previous cycles? So the yellow bars here are Bitcoin halvings, and you can see this is the issuance decreasing per block about every 4 years, and the next halving is coming up in April 2024, so under a year away here. And in a pre-halving year, we have historically had a run up and then sort of petered out over time. It's happened 2012, 2016, 2020, but the importance is after halving is where we see that price appreciation start to lift. So as maybe bearish as I am in the near term, in the hyper near term, in the next 2 to 4 months, in the long term, there's no concern for me whatsoever because we still have plenty of time. Now, if after halving we are down 80%, right, then I need to rethink my investment thesis and what's going on there, but that's certainly not the expectation. And using log regression, power law corridor, it certainly looks like it's closer to the bottom than the top. Zooming in a lot here, now this is really the past year, we can see we bottomed out, we had a base, we had some event-driven news, SVB, banks blowing up, that sort of thing, really helped propel the narrative and propel Bitcoin higher. And we've held within this bullish pitchfork, kind of teasing an attempt to break down from that, or teasing an attempt to break down from the 200-week moving average, and potentially returning to whatever this Frankenstein's monster of a head and shoulders, inverted head and shoulders this was before we broke up in March. But all of this points to the same place in that potentially 24, 23K area. And on top of that, there was also a triple top head and shoulders to sort of set this all off. So we haven't yet broken down, but that continues to be the expectation that this will break down sooner rather than later at this point. I wouldn't expect a higher high, but if we do get a higher high above 28, 29K, then that probably signals bullish continuation. And you'd be able to see that on something like the cloud, where currently we're inside of the cloud. And when you're inside of the cloud, you typically reach for the other edge of the cloud. Now we haven't done that yet, but again, that aligns with that 23 to 24 range. So the expectation here is definitely neutral to bearish still, even on the cloud. Anyway, I try to slice this in the lower time frames. From a technical perspective, certainly looks neutral, the very best, bearish, most likely case. Looking at Bitcoin dominance though, relative to Bitcoin, relative to the rest of the ecosystem, Bitcoin dominance looks extremely strong. So we are likely seeing exodus out of altcoins, at least in a faster manner than Bitcoin. If we look at retail speculators down significantly over the past year, exchanges where we can trade this stuff globally continue to close in Canada, Australia, and there's definitely regulatory concerns with a lot of this stuff as well. If you're trying to trade Solana and you want to stake it in the US, you may not be able to do that how you want to do that if you're a retail participant. So that's certainly hurting altcoins relative to Bitcoin. That's why you're seeing this pop in Bitcoin dominance, and this looks to me like it's going to continue to move higher. Looking at ETH addresses that have at least 0.01 ETH or greater, those have also grown since 2020, since 2021. And even after, the staking became popular, you're continuing to see individuals hold on to ETH, acquire ETH, and not leave the ecosystem. So we certainly aren't seeing people just throw up their hands and say, you know what, I'm done with crypto entirely, even though from a content and engagement perspective, volumes, all this stuff is sort of hand in hand. Like I talked about last week, if you're looking at Google Trends, volume, NFT mints, NFT trading, YouTube video views for our content creators, all that stuff from a social perspective is all realistically the same. So even though the sentiment broadly is unexciting, let's say, there's still individuals who are acquiring cryptocurrency here and holding on to it. If you look at the staking aspect, ETH has seen 2.4 million ETH flowing into staking since staking went liquid a few months ago. Now, just like Bitcoin and the Bitcoin mining pools, ETH has a centralization risk here with Lido, which is one of the staking services you can use as an individual. Now, the problem here is that Lido is so much better than the other options that I expect this centralization component to continue. At some point, the network may have to take action here and say, through a potentially socially slashing them or decreasing their rewards, that you need to move this around. Even though this is a pool, there are some real centralization risks here. So people need to continue to make noise about this, and then things will happen, and not waiting till the last minute and something happens. Even at 33% with proof of stake, there are ways to gamify nefarious actions. So other staking services need to become more competitive in order to have a chance to break up this centralization. It's a problem that's fixable. It's just at the moment entrenched in the system because of the rewards that you're getting at Lido relative to the other services. Or just spinning up a node yourself and validating is difficult, to say the least, and it's just easier from a retail perspective to use a service like Lido. Coinbase here, the third biggest slice other than the unidentified slice. Now, some have speculated that even in this unidentified slice, that is also Lido to some degree. So we don't actually know for certain, but there is a real centralization risk here for sure. Looking at some technicals for ETH, and much like Bitcoin, zooming out long term, ETH has a lot less price history, obviously. But if you are a long-term believer in DeFi, NFTs, the financialization of crypto, I don't think there's any reason to be concerned generally. I think the bigger concern in the near term is whether or not ETH is a security. Will there be clarity around that? Will there be clarity around what DeFi is? Is all of DeFi going to be considered a security, for example? But on a technical basis, this still looks okay because, again, we're not above the weekly cloud. We are in a massive bullish channel still, even below 1,500, closer to really 1,000. This would be okay. It's still below the cloud. There is not an expectation of bullish continuation on a weekly basis, not until we're above this level here. And you can see, just like 2020, when we got above the weekly cloud, then it was go time, And in 2024, around Bitcoin's halving is where ETH, riding on the coattails of that, may also see significant price appreciation. So from a long-term technicals perspective, I still like where ETH sits here. It doesn't look bearish by any means. It just looks neutral and waiting, much like it did in this 2019-2020 period, where we're just making a base until we make a decision, potentially for higher, and that's certainly what it looks like based on, the chart patterns here, Adam and Eve, inverted head and shoulders, however you want to think about that. Certainly looks good for higher eventually. ETH relative to BTC, also interesting that it's green over the past 5 weeks. Every day it's kind of up. It's not up a little less, but it's down a little less than Bitcoin when it is down. And you're certainly seeing that on a weekly basis with 5 green weeks in a row here. Ultimately, though, again, regulatory concerns are massive. Retail speculation is largely gone here. And that really was what fueled ETH in 2017 relative to Bitcoin. Certainly what fueled it in 2020, thanks to DeFi in 2021 and NFTs later on in 2022. But until I see an uptick in that regulatory clarity, even in staking regulatory clarity, I have a hard time fundamentally seeing ETH BTC outperforming in a massive way. But on a technical basis, if this does start to make higher highs above 0.08, then it might be go time for a move to 0.1, which is where everyone's going to be looking at. But just as we stand here now, this is potentially a diamond top chart pattern fractal, and that would point to a bearish reversal. So certainly not bullish on ETH BTC as we stand here, really until there's regulatory clarity around ETH as an asset, staking as a service and what retail can do with that, and really all of DeFi, which may be under the securities umbrella. Lastly, just looking at total 3 here on TradingView, which is the entirety of the crypto ecosystem without Bitcoin and without Ethereum. So other than the top 2 assets, what does that chart look like? This is market cap now. And again, from a fundamental perspective, if we're closing exchanges, if retail investors are squeezed with inflation, if retail speculation is down, attention eyeballs are down, regulatory clarity is unclear, I just don't see altcoins doing well in the near term. And from a technical basis, until we're above maybe 400 billion here as a group on aggregate, it's just uninteresting and unexciting, and we may continue to range at this level. Now you could argue this is building an inverted head and shoulders or some sort of base here, triple bottom, but I wouldn't get too optimistic until we're back above that 400 level. So that's all for this one. This video is for informational purposes only, and the opinions expressed are not financial or investment advice. All opinions are my own and do not reflect the opinions of Valkyrie Investments and its affiliates. No fiduciary obligation or duty exists or is created between you and Valkyrie Investments or its affiliates, including me, by virtue of any opinions expressed in this video.